Good morning, all. Last class we studied about business financing. We talked about money market, capital market, the major differences between the two, the instruments that are traded in each of the markets, and then we also explained bonds. Bonds were defined as fixed income instruments or debt instruments, and discussed the various concepts relating to bonds, primary, secondary market, and the three major risks associated with bonds. After that, we also explained shares and what a share is, how a share is formed, rights and obligations of a shareholder, and how a share is created. We discussed the importance of SEBI, what a primary market or an initial public offering is, then the role of NSE and BSE in facilitating trading of the shares in the secondary market, and some of the intermediaries like NSECL, CDSL, and NSDL. We also explain how a share price moves, what leads to movements in the prices of shares. There can be global events that leads to variations in share prices. There can be national events or company specific events which leads to fluctuations, up and down movements in the prices of shares. Now we'll explain two concepts, Nifty and Sensex. You might have heard about these terms. These are very popular terms that we regularly come across in the media. Okay, so Nifty and Sensex are two acronyms. Nifty stands for National Stock Exchange 50 and Sensex stands for Sensitive Index. We know that there are many companies listed in each of these share markets, stock markets, NSE and BSE. There are around 2,500 shares listed in NSE and around 10,000 shares listed in BSE. So how do we know the average performance of each of these companies in a day? We know that the share prices goes on fluctuating each day. So we need to have a rough idea about how the market moves on an average, because market ultimately reflects the economic condition. So how do we do that? We cannot take the values of all these shares together. For example, there are around 10,000 shares listed in BSE. So we cannot go through the prices of all those shares to have a fair understanding about the average market performance. And it is also difficult to take the average prices of all the shares traded, because some of the shares may not be traded at all, some of the shares may be suspended. So there are very many technical reasons why we cannot go through the prices of all those shares. So in order to have a fair idea about the performance of the share market in each of the day, these stock exchanges have devised indices. Nifty and Sensex are two such indices. So Nifty is the flagship index of NSE, National Stock Exchange, and Sensex is the flagship index of Bombay Stock Exchange. Okay, so Nifty consists of the 50 selected stocks traded in NSE. So out of the around 2,500 shares that are listed in NSE, NSE has selected 50 companies based on certain criteria. The criteria includes the profitability of the firms, fair management practices followed, liquidity, size. These are all some of the criteria that are used to select the firms. So usually the companies selected or included in Nifty will be the best ones in the National Stock Exchange. So these are the 50 best performing stocks in the National Stock Exchange. Similarly, BSE, Bombay Stock Exchange, has also devised their own index, which is called the Sensex. They have selected 30 companies from the whole population of companies listed in BSE and arrived at the average price of these 30 companies. So that is the value of Sensex. So Sensex and Nifty represents the average price of the selected companies from each of the stock exchanges, and this average is called the weighted average, the weight being the size of the company. A larger company will have larger weight, and the size of the company is determined by capitalization. It's called market capitalization. Capitalization is arrived at by multiplying share price into number of shares. For example, if there is a company ABC, it has issued 100 shares. So these 100 shares are being traded in the exchange. Suppose its price is 10 rupees, then the capitalization of the company will be 10 into 100 is equal to 1000 rupees. This is the capitalization. There are two types of capitalization. One is free float capitalization, another one is full capitalization. We know that some of the shares are owned by the promoters and they keep with themselves. So these are not available for public trading. Take the case of our previous company ABC, which had 100 shares. Out of those 100, suppose 50 of the shares were with the promoter, or popularly the owner of the company. Means everybody is an owner, but promoter is somebody who has founded the company and promoted it. So suppose those 50 shares are with the promoter and they are not publicly available for trading. So the balance 50 shares are called free float shares because they are floating in the market. They can be bought by anybody. So when we are taking only these free float shares and multiplying with the share price, we get free float capitalization. Whereas full capitalization is a case where we are taking all the shares. That is, in the case of ABC company, we are taking all the 100 shares and multiplying with the share price to obtain the full capitalization. So this is the difference between free float capitalization and full capitalization. Free float capitalization is a better way of finding the size of the company, and both these exchanges follow different methodologies in constructing the index. Nifty or National Stock Exchange considers free float capitalization, whereas Bombay Stock Exchange considers full market capitalization. So these are the 50 shares, 50 or 30 shares. So these are the ways in which the index is formed. Okay, so we will see the constants of the index. There are different sectors to which the companies belong. For example, there will be information technology companies like TCS, Infosys, Wipro, HCL Technologies, Larsen & Toubro, Infotech. And there will be banks like SBI, HDFC Bank, ICICI Bank, Axis Bank. There will be petroleum refining companies, marketing companies, pharmaceutical companies, fast-moving consumer goods, engineering companies, automobile companies. These all form part of the index. So we will see the components of National Stock Exchange 50, and we will go to the NSE website. This is the NSE website. So you can see nseindia.com. You will get all the information about the market from this website. This is the home page of NSE, and you can see here this value here 22,650 is the current value of Nifty. Okay, average value of Nifty. So this shows the graph how the market has performed today from the opening 915 to 950 today, and you can see these are the shares. If you give the click the view all button, then you will see all the shares listed in the National Stock Exchange. So these are the shares listed in National Stock Exchange. 50 shares listed in Nifty, Divis Laboratories, Tata Motors, NTPC, Coal India, Nestle India, Bajaj Auto. So these are the some of the companies that form part of the Nifty. And you can see here, this is the open price, high price, low price. Volume means number of shares traded. So here you can see that in the case of Divis Lab, the volume is 1,15,052. In just 35 minutes, it has been traded to the extent of 1,15,000, and the value is 43 crores, and the value differs for different companies. Here you can see values goes on changing for different companies. There is 436 crores in the case of TCS. So it depends upon the size of the company also. Bigger the company, more will be the trading. For example, consider Reliance here. It is traded to the extent of 593 crores in the last 30 minutes. Similarly, you can see the case of BSE, Sensex. This is the home page of BSE, and here you will see the names of the stocks listed in BSE: Tata Motors, NTPC, Nestle, Axis Bank, TCS. Those shares that are seen in green background are the ones whose price has appreciated today, and the ones in red shows price depreciation. So most of the shares have come down today. Yesterday was a holiday because of Eid, and day before yesterday there was some bad news with regard to global markets, and therefore that's why the market is down today. So these two websites give you plenty of information about the market, and then this is one app belongs to investing.com, in which you can see all the details about the shares, more attractive one, because there are many more options here. So it shows the graphical presentation of Nifty over the last 1 year. So last 1 year you can see it has gone from 18,800 to currently at 22,600. You have different options. This is a monthly statement. So from 2010 to 2000, the details, the performance of the index, that is Nifty, from 2010 to 2024 can be viewed here. You can see that 2010 it was nearly 6,000. Now it is at 22,000. So over the last 14 years it has almost risen by 4 times. So there is plenty of information available in the case of all the shares. This is the case of Sensex. Similar information can be got in the case of Sensex also. They move almost in tandem, because most of the companies that form part of Sensex also form part of Nifty. Okay, so this is about Nifty and Sensex. Now we'll move on to explain two other concepts which are called Demat account and trading account. Okay, so who can buy shares? Who can buy shares listed in NSE or BSE? Actually, any person who is of good state of mind, above 18 years, can buy shares. And actually even minors can buy shares, but with the supervision of their guardians. Okay, so people need to open an account to buy shares. This account is called a Demat account or a trading account. So first we'll talk about the Demat account. Demat account again is an acronym which stands for dematerialized account. Earlier years, that is before 2000, shares were in physical form. That is, when you bought a share, you used to get a certificate, a paper certificate. You used to get a paper certificate through mail, and this was quite inconvenient. There was many problems associated with it. After digitalization was introduced in stock markets, shares are kept in the form of digital certificates. So this is called dematerialization. That is, the material shares are being dematerialized and are kept in the form of digital certificates. This is called a Demat account. So Demat account is just like a bank account. In a bank account you hold your cash, whereas in a Demat account you hold your shares. There are two depositories who are the custodians of Demat accounts of people. They are NSDL and CDSL, National Securities Depository Limited and Central Depository Services Limited. Okay, so anybody who wants to trade in the share market need to open an account. They need to submit their KYC documents like photo, ID proof, address proof, Aadhaar card, bank passbook, copy of bank passbook, and all those documents, whatever they are demanded by the brokers. So we submit these documents to a broker, and broker open an account for us either with NSDL or CDSL, and after the account has been opened, we can deposit cash into the account. Actually, cash is deposited not to the Demat account but trading account. Demat account actually holds only your shares. So when you deposit your cash, you can place your order with the broker, or you can trade for yourself through terminals, through either your laptops or mobile phones. So when you are paying cash and giving a buying order, then the shares will be credited to your account. These shares will be credited to your Demat account, and this is the purpose of a Demat account. It keeps your shares in digital form. Okay, and why there is a trading account? The second account connected with the trading of shares is called a trading account. So we said that Demat account only keeps shares, and we need to deposit cash also with the broker to buy shares. So where does this cash go? This cash is actually kept in the trading account, and also shares that are temporarily suspended are also kept in the trading account. For example, when you are deciding to sell a share or buy a share, suppose you have decided to buy a share and you place the order, but the payment get credited to the counterparty only after 2 days. Till that period of time, the share that has been bought is kept in the trading account. So it is a temporary account or a temporary place where shares are kept for a short period of time, or the shares are in transit. The shares are kept in the trading account when they are transit from one individual to the another one. So trading account serves these purposes. Actually, when you open a Demat account, a trading account is also open along with that. So this is all about Demat and trading account, and hope you got an idea about this. You can contact me back for in clearing any doubts. Thank you.